Hello, good evening.
Good evening,
Trust
sir.
you have a lovely day.
Good evening, sir.
Yeah.
Good evening.
How you
Good
doing?
evening, everyone.
Good
Good
evening.
evening, sir.
Good
Yes,
evening,
I
sir.
have
Good evening, sir.
in addition to my usual online class student, I should be having some students, or I should be having students from the physical class joining. The topic we are looking at is capital structure and the theory of gearing. This topic can be treated with one lecture. Of course, capital structure and theory of gearing is an extension of cost of capital computation. It is to further improve your knowledge of cost of capital computation. 90% of what will be treated here, it's not impossible that you have come across it in the course of treating cost of capital. So we shall be looking at capital structure. Let me try and share my screen. No, just 1 minute. Just a minute. All right, let's continue while we wait for the coordinating director to allow us to share our material. Now, an introduction to the topic, capital structure. If you pick a company financial statement, if you pick a company's annual statement, annual reports, you are going to have statement of financial position or the balance sheets. Now, if you look at the balance sheets, you have the non-current assets, you have the current assets, you have the current liability and non-current liability. Then you now have capital and reserves. Our discussion today is that capital and reserves. When we say capital structure, it simply refers to how a company is being financed. When we say company's capital structure, a company capital structure refers to the different sources of finance the company has employed to execute its business objective. Basically, capital structure refers to the different sources of finance the company has employed in order to execute its business objective. Okay, let me share. All right, I was waiting for the coordinating director. Let's go to the business. The capital structure of a company refers to the medium, long-term, and the permanent capital and the relationship between them. Basically, capital structure will include ordinary share capital, reserves, and long-term borrowing in the form of debentures. Let me take that again. Typically, a company capital structure will include the ordinary share capital. The ordinary share capital represents equity financing, the money contributed by the owners of the business. Reserves. Reserve represents that part of the company's profits that is retained and reinvested in the business. We refer to it as equity reserves. Where a company retains part of its profits, that means that reserves or that retained earnings can be reinvested in the business for future growth. Then we now have long-term borrowing in the form of debentures. Sometimes business entity relies on short-term borrowings like bank overdraft or short-term trade finance to finance their operation. So in summary, capital structure refers to the different types of finance the company has employed to execute its business. Company can be financed by equity or debt or a combination of equity and debt. Usually, companies are financed by a combination of equity and debt. Please remember, if a company is financed by equity only, such company is referred to as ungeared firm. Let me take that again. Please note, where a company is financed by equity only, such company will be categorized as ungeared firm. On rare occasion, where a company is financed by debt, that will be very unusual. That will be extremely unusual. That a company has just borrowed all the money to finance its business. It is highly unusual. But we can also have a combination of equity and debt. Where a company is financed by a combination of equity and debt, we refer to such company as geared company. All right. Sure. A company could be geared or a company could be ungeared. Risk. What is the risk involved in capital structure? What is risk? Risk can be defined as the variability in returns. If you are required to explain risk, risk is the volatility in your return, the variability in return. For example, if you invest in a project, you have an expectation of return. The risk is the variability in your expected return. You can measure risk using standard deviation. When you get to portfolio theory, I don't know if Juwan has started portfolio theory with your class. Juwan will explain more on risk. Now we have business risk. can also have financial risk. I think this thing is faint. Let me take this to black. Now you have business risk. This is the variability of the firm's operating income. When we say business risk is the variability in the company's operating income. Operating income is the income before interest and tax. Business risk is the risk associated with the nature of the business. Then number two, before I move to number two, please note, if a company is financed by equity only, such company will be exposed to business risk only. Let me take that again. Where a company is financed by equity only, such company will be exposed to business risk only. And also note, the index that measures business risk is the asset beta. Asset beta is used to calculate business risk. Number next, financial risk. This is the additional variability in return to shareholders that arises because the capital structure contains element of debt finance. Please note that point. Financial risk is the additional variability in returns to shareholders that arises because the company capital structure contains element of debt finance. It is the risk over and above the normal business risk. And please note, financial risk will only happen when a company has borrowed money. Financial risk is associated with debt financing. In other words, if a company is financed by equity only, then that company will not be exposed to financial risk. You need to watch it. The terminal says this company is all equity finance. That means the company is not exposed to financial risk. All right. Our next discussion. What is gearing? We also call it leverage. Gearing is the actual mix of debt and equity financing used by a business entity. Gearing is the proportion of debt finance to equity financing. Gearing, proportion of equity finance, proportion of debt finance to equity finance. Gearing can be defined as the extent to which a company is financed by debt. The extent to which a company has borrowed money to finance business. There are different ways of calculating gearing. There are different formulas for calculating gearing. But please note, except the examiner stated or otherwise, your gearing should be calculated as total market value of debt to total market value of equity. Please note, unless the examiner stated otherwise, at any point in time you want to calculate gearing, you are going of debt, the market value of equity. You can also calculate gearing using the book value approach. Long-term debt divided by the shareholders' funds can calculate your gearing. Remember, gearing is the proportion of debt finance in a company capital structure. You can compute your gearing. Now, implication of gearing. What is the implication of introducing debt finance? When we say implication of gearing, it simply means what is the risk or what are the implications of introducing debt finance into a company capital structure. So if you are saying implication of gearing, it simply means what is the implication or what are the implications of introducing debt finance into a company capital structure. A company can decide to finance its business with equity only. A company can also decide to borrow money to finance its business. As soon as a company introduces debt finance into its capital structure, that means the company has introduced gearing. It also means the company has introduced financial risk into the business. Let me repeat that point. Let's assume a company is financed by equity only. We have floated a company and we decided to finance the business with our money, our equity. A year later, we decide to borrow money to support business expansion. That means we are introducing debt finance into our capital structure. Please note, as soon as debt finance is introduced into a company capital structure, the ordinary shareholders will demand additional returns. The shareholders will demand additional return. Why are they asking for more return? Because we are introducing financial risk into the business. That means the risk of the shareholder will increase by introducing financial risk. Before, the shareholders were exposed to business risk only. Now the company is bringing in debt finance. And that means the company is introducing financial risk into the business. Ordinary shareholder will demand additional returns for their business. Provided the company is able to achieve higher earnings, the shareholder will continue to get higher returns. But return to debt holders will remain fixed because the interest rate is fixed. If the interest rate is 10%, even if the company make more profits, debt holder will only get 10% interest rate. Why the shareholder will continue to take more profit? Now, let us discuss theories of capital structure. Please note, when we say theory of capital structure, we are also referring to theories of gearing. There are two main theories of capital structure. Two main theories attempted to explain effect of changes in gearing. Let me take that again. Two main theories attempted to explain the implication of changes in gearing on the weighted average cost of capital and on share value. Please note, when we say changes in gearing, we are referring to changes in company capital structure. There are two main theories that attempted to explain the implication of changes in capital structure on the company's weighted average cost of capital and on the company's market value. These theories are: one, the traditional theory of capital structure. The traditional theory of capital structure. Please note, traditional theory is also called net income approach to capital structure. We also have Modigliani and Miller theory. Modigliani and Miller theory of Modigliani and Miller in relevance theory of capital structure. M&M is also known as net operating income approach. Let's take the first one. The traditional view of capital structure. We can summarize this. The traditional view of capital structure argues that there's an optimum level of capital structure for every company. The traditional theory of capital structure is of the opinion that every company has an optimum level of gearing. And that optimum level is achieved at a point where the weighted average cost of capital is minimized. That optimum level is achieved at a point where the weighted average cost of capital is minimized. In other words, company can introduce debt finance into its capital structure. Company will continue to put debt finance into its capital structure up to a point where the weighted average cost of capital is at minimum level. Once the minimum level is achieved, then company must stop adding capital structure. Sorry, company must stop adding debt finance. Once a company achieves a minimum WACC, then that company must stop the introduction of debt finance. In line with the traditional theory, if gearing increases, please note, when we say gearing increases, it means that if debt finance increases, the cost of equity will rise. You know why? Ordinary and additional return as a compensation for additional risk. Risk is the financial risk. So if a company introduces debt finance, that means gearing will increase. Ordinary shareholder will demand additional return. However, there is a greater proportion of debt finance. There is a greater proportion of debt finance in the company capital structure. And the cost of debt finance is cheaper. A cheaper debt finance with higher cost of equity. Let me take that again. A cheaper cost of debt with higher cost of equity will continue to reduce the weighted average cost of capital. Cost of debt is cheaper. Cost of equity is increasing. Weighted average cost of capital will continue to fall. But it will get to a point as more debt is introduced into the business. Cost of debt will now start increasing. At that point, the traditional theory is saying that stop adding debt finance once you have achieved the minimum WACC. Where WACC is minimized, the value of the company is maximized. Please note that last point. The traditional view of gearing is therefore that an optimum level of gearing exists, where the weighted average cost of capital is minimized and the value of the company is maximized. At that point, we must not have debt finance. Again, And please note, you can only use WACC to appraise a project. Weighted, okay. Let me read this out. I want to emphasize a point here. The conclusion of the traditional theory is that an optimal capital structure exists in which the weighted average cost of capital is minimized and the value of the company is maximized. The use of WACC to appraise cash flows of investment projects has been justified in a situation where gearing is not expected to change in the long run. That is the point I'm trying to emphasize. You can only use WACC to appraise investment projects on the condition that the company's capital structure will not change. As soon as a company capital structure changes, then WACC will change. Market value of the company will also change. So please keep this closer to yourself. This knowledge is needed beyond cost of capital computation. If you are dealing with investment appraiser and you want to appraise that new project, you can only use WACC to appraise a project on the condition that that company capital structure will remain unchanged. Once there is a change in company capital structure, we must recompose another WACC. All right. The second theory, Modigliani and Miller theory. Modigliani and Miller without corporate taxation. M&M predicted or developed a model to explain that company's capital structure is not relevant to company's market value. Modigliani and Miller developed a model to explain that increase in gearing or change in gearing will not have any impact on the company's WACC and will not have any impact on the company's market value. In other words, M&M is saying that capital structure, how a company is financed, when we say capital structure, how a company is financed is not relevant to a company's market value, provided there is no taxation. For example, company A is financed by 100 million equity and debt. Company B is financed by 100 million naira debt only. The total amount is 100 million now. Company A has gotten 100 million. Equity and debt financing, total 100 million. Company B has gotten 100 million. All debt finance. M&M is saying that how a company is financed is not relevant to a company market value. What is important is for company to utilize its finance to generate more earnings. What determines company's market value is ability to generate sufficient earnings, not how a company is being financed. That is the position of M&M, provided there is no taxation. In line with M&M, as gearing increases, there is greater proportion of cheaper debt finance. It means that cost of debt finance is cheaper. Cost of equity will rise. The net effect is that the rise in the cost of equity will be offset by reduction in the cost of debt. If cost of equity is increasing, cost of debt will reduce. Weighted average cost of capital remain unchanged. Are we there, please? As gearing increases, shareholders will demand additional return. Hence, cost of equity will increase. But cost of debt finance will fall because debt finance is cheaper. The increase in the cost of equity will be neutralized by the reduction in the cost of debt. Hence, WACC remain unchanged. And once WACC remain unchanged, market value of the company remain unchanged. That is the position of M&M, provided there is no taxation. This theory or the argument of M&M, ignoring taxation, can be summarized as two propositions. M&M argument, ignoring corporate taxation, can be summarized as two propositions. Proposition 1, please look at it and please pay attention to it. Provided there is no taxation, the weighted average cost of capital of a GIE company is the same as the weighted average cost of capital of an identical GIE company. Look at it here, please. Provided there is no tax, weighted average cost of capital of a GIE company is equal to the weighted average cost of capital of an un-GIE company. Also, the market value of an un-GIE company, look at it. The total market value of an un-GIE company or of a GIE company is the total market value of an un-GIE company, in as much as there is no taxation. In as much as there is no taxation. Proposition 2. The cost of equity in a GIE company is higher than the cost of equity of an un-GIE company. Look at the formula here, please. Please take note of that formula. KEG, cost of equity of a GA company, is equal to cost of equity of an non-GA company plus value of debt over value of equity multiplied by cost of equity of an non-GA company minus cost of debt. This formula is also available in your study pack. Please take note of this. You may require it when calculating cost of equity, when calculating your cost of capital. Like I said, this is to further improve on the knowledge you have gathered on cost of capital computation. You can take note of this definition. We have explained all this. Weighted average cost of capital of a GA company. You can look at it. We also have Modigliani and Miller theory allowing for corporate taxation. The first theory, M&M without corporate taxation, was developed in 1961. In 1963, M&M refined their theory to include corporate taxation. Let's look at these comments here. M&M model without corporate taxation lead to the conclusion that gearing is irrelevant. Please, when we say gearing, capital structure is not relevant. How a company is financed is not relevant. However, this theory is clearly not true in the real world, because the model developed by M&M ignores corporate taxation. In reality, company will pay tax. Individual will pay tax. In 1963, Modigliani and Miller revised their theory to include corporate taxation. The inclusion of corporate taxation significantly changes their analysis. The inclusion of corporate taxation significantly changes their analysis. With corporate tax, return to debt holders. Please note, when we say return to debt holder, return to debt holder is interest received. So the company borrowing money is interest paid to the lenders. And please note, lenders are referred to as the debt holders. To the lenders, that becomes interest receivables. With corporate taxation, returns to debt holders are tax allowable. Therefore, M&M concluded that GH firm have advantage over on GF firm because they are going to pay less tax. If you finance your business with debt, then such company will have advantage over other companies that are financing by debt. In other words, the market value of a GH company will be greater than the market value of an un-GH company. The cost of capital of a GH company will be lower because the company will enjoy tax relief on interest paid. Taking into account taxation, M&M concluded that GFM is better than on GFM. The summary of M&M with corporate taxation that we don't bore ourselves with that long note. M&M, both Declining and Miller, reached the conclusion that because of tax relief on interest, there's an optimum level of gearing that companies should try to achieve. And a company should try to make its gearing as high as possible to the maximum practicable level. Companies should utilize debt finance more, because debt finance is cheaper. The interest payable on debt finance will reduce the overall cost of capital, and the market value of the company will be enhanced. Now again, the argument of M&M allowing for corporate taxation can be summarized as two propositions. Excuse me, please. Proposition 1, weighted average cost of capital of a GH company is lower than the weighted average cost of capital of an un-GH company. I will expand this briefly. Weighted average cost of capital of a GH company is equal to the WACC of an un-GH company, open a big bracket, 1 minus DT. That is debt multiplied by tax rates divided by debt plus equity. Also note, the market value of a GH company is greater than the market value of an ungeared company. Please note, value of a geared is equal to value of an ungeared plus the debt times tax. Lastly, the cost of equity of a geared company is greater than the cost of equity of an ungeared company. Look at it carefully. We have just introduced tax. Look at it. Cost of equity of a geared company is equal to cost of equity of an ungeared company plus 1 minus tax rate, bracket 1 minus the tax rate, bracket cost of debt, cost of equity minus cost of equity of an ungeared company minus cost of debt multiplied by debt to equity ratio. These are the two main theories. We have other theories that try to explain capital structure, but the first two represent the two main theories. The other theories we can summarize in 2 minutes. We have static trade-off theory. This theory argues that there's an optimum capital structure, and that optimum level is achieved. Look at it. The optimum level is reached at a point where marginal benefit of debt financing equal the marginal cost of debt financing. A point where your marginal benefit of debt finance equal to the marginal cost of debt finance. That point represents optimum level of gearing. That is the position of static trade-off theory. We have who is that?
Sorry.
Can you explain the static trade-off again?
Okay. Okay. Thank you for muting. Pick another theory.
Excuse me, sir.
Yes, ma'am.
Sir, please, can you explain the static trade-off theory again, please?
The summary. It says there's an optimum level of gearing. That optimum level is achieved where marginal benefit of debt finance is equal to marginal cost of debt finance. That is the summary. Every other thing you see there is long notes. When we say marginal benefit of debt finance, please, what is the benefit of debt financing? Benefit of debt finance is tax relief on interest paid. At a point where you have maximum tax relief, that becomes marginal benefit of debt finance. What is the marginal cost of debt finance? Marginal cost of debt finance is the risk that if you borrow money too much, the lender, your financial risk will increase. So once you get to a point that your financial risk is getting to the highest level, you need to stop. So you are going to watch it. That's why, but this environment, examiner will not ask you for any calculation here. That's why I'm summarizing this. I'm trying to move out of it. There's no calculation involved with static trade-off theory. But for knowledge purposes, if you have to explain static trade-off theory, that the theory argues that there's an optimum level of capital structure where, and that optimum level is achieved where marginal benefit of debt finance equal marginal cost of debt finance. What is benefit of debt finance? Tax relief on interest payment. What is the cost of debt finance? Beyond the interest you are paying, if you are borrowing money too much, you are exposed to higher financial risk. If the company fails to pay the interest and the principal repayment as at Wednesday, the lender can force the company into liquidation. That is the risk of debt finance. So company must watch it. Is that better, please?
Yes, it is. Thank you, sir.
All right. Pecking order theory. Pecking order theory takes a different view of journey. In fact, pecking order theory is a direct challenge to static trade-off theory. The theory states that there's nothing like optimum capital structure. That's nothing like optimum capital structure. In fact, companies should not be bothered about optimum capital structure. With this theory, companies show preferences for finance success. There's an order of financing, a pecking order of financing. If a company wants to finance a project, companies should start with retained earnings. Because retained earnings is cheaper. Retained earnings is readily available. So companies should start with with retained earnings. If company is done with retained earnings, then company can go to debt financing. The second order, company should borrow money. If company has exhausted debt finance, the company can now issue equity. That's this order. You should finance your business by looking at the cheapest one, use retained earnings. The class is on. No. Then followed by debt, then followed by equity. That is the pecking order theory. Let's look at the summary of this theory. Pecking order theory states that the journey of a company is the result of financing decision based on the preferences for source of finance. An optimal level of journey does not exist. That is the position of pecking order theory. And companies should not try to achieve optimum level. Rather, companies should follow preference of financing. Lastly, market timing theory. But please note, the first two theory is a must know. I'm not saying the last three is not important. That first two, particularly M&M, you cannot, if you are on gearing and regearing, what you are doing is M&M. You cannot do SFM without on gearing and regearing. All right. Market timing theory states that the choice of financing method for companies driven by opportunities in the capital markets. That is, whether a company will use equity finance or debt finance will depend on the opportunities available in the capital markets. These opportunities occur because of asymmetry of information. Okay, no problem, we try. Thank God for the rain.
Sorry, sir.
Please, if you want to speak, you can only signify by raising your hand. Yes, we can hear you.
Sir, please explain the market timing theory again.
I've not finished. I've not even
Start from the beginning.
But I've not even gone far. I'm seeing down that theory. We said market timing theory states that the choice of financing method for companies can be driven by opportunities in the capital markets. It means that whether you are going to use debt finance or equity finance will depend on the opportunities available in the capital market. And these opportunities occur of asymmetric of information. Let me explain that. We call it dysfunctional information. Information available to the managers of a company is different from information available to the shareholders. Let me explain that briefly. Where you work, assuming you are part of the company's management, you have access to more information than the shareholders that are just invested in the company. You go to office on a daily basis. You are part of management, you discuss in the office. That means you are going to have access to more information than the investors. As manager or as a management team, you know when it is more appropriate to use equity financing. You know when it is more appropriate to use debt financing. The management of a company have access to more information and better information than the shareholders. The management knows when the future prospect of the company is better. The management knows when it is more appropriate to finance the business with equity and when it is appropriate to finance the business with debt. So what market timing is saying is that companies should finance advantage of opportunity in the capital market. If the company shares is overvalued, then company can issue more shares and make more money. In that case, you can issue more shares, sell more shares, and make more money. That means you can issue more equity. If the company's share is undervalued, at that point, it makes no sense to issue more equity. Because if you issue more equity, you are going to further depress the company share value. At that point, company can consider debt finance. That is what market timing theory is explaining. Is that better, please? All right. We are done with the explanation. I was trying to work towards 10 o'clock. Albeit, we have spent 10 minutes extra. Any question? Okay, if there's no question.
Sorry, sir. Good evening, sir.
Yeah, good evening, sir.
Okay, please, I'm not trying to draw you backward, but I didn't really get that traditional view of capital structure. I don't know if you can show more light on it, sir.
Okay. Traditional view simply means that there's an optimum level of capital structure that companies should pursue. It means that companies should utilize debt finance. Companies should take advantage of debt finance, because by using debt finance, company will enjoy tax relief. That tax relief will reduce the company's cost of capital. Reduction in cost of capital will maximize the company's value. Companies should take advantage of debt finance. However, companies should know when to stop adding debt finance. Once the company has achieved a minimum weighted average cost of capital, companies should stop adding debt finance. So once you achieve minimum WACC, that point where the WACC is minimized is referred to as optimum level of capital structure. Is that better, sir? All right. Michelle, I don't know if I'm correct.
Yes, sir, you are. Yes, sir, you are.
Yes, your question.
Okay, quick one, sir. This Modigliani and Miller hypothesis.
Yes.
You made mention of the first one that is with tax and the
without
second
corporate
one.
taxation.
Both are valid, right?
What do you say, please?
I mean, the both theories are valid.
What do you mean by valid?
Okay. What I'm trying to say is that I think the second theory is like a modification of the first one.
Yes, the second theory. Okay, that first theory is on the assumption that there is no taxation in the economy.
In reality,
but in reality, there's corporate taxation. So
sure,
there's a limitation with that first model, without corporate taxation. The second model with corporate taxation, the second model is more realistic. That in practice, there's company will pay tax, investors will pay tax. So the second model is more valid.
So if I'm going into the exam hall, I should be expecting the second one instead of the first.
Why? Examiner can test anyone now. Examiner can deliberately tell you to, assuming there is no taxation. Is that not?
Okay.
Or examiner can tell you to ignore tax, You are going to pay for the two.
Okay. Thank you.
All right, sir. I wait to. Okay, Zainab. I was saying where is Zainab, because I know that those are my online students on a normal day. All right, let's go to question number 1. Lower the hand. Are you still having question? Michelle?
No, sir. I'm trying to pull it down.
I'm trying to bring the hand down. So. All right, illustration 1. Yeah, Zainab. Okay, let me do my reading. Let me allow you to rest, Abby. But prepare after the first reading. When we start solving questions in class, somebody have to read it too. For the physical class student, please go to your study pack, open to the last chapter. This should be question number 1 or 2. It should be question number 1 or 2 in your study pack. I think it's question number 1. Check your study pack. The question is available in your study pack. And now let's go to it. The finance director of Cooper PSC is concerned about the impact of capital structure on the company's value. Look at it. The directors of Cooper PSC or Cooper PSC is concerned about the impact of capital structure on the company's value and wishes to investigate the effect of different capital structures. Is aware that as gearing increases, required return on equity will also increase. And the company's interest cover ratio, interest cover, is likely to decrease. Is that not? If gearing increase, cost of equity will increase. Interest expense will increase. Interest cover will fall. A decrease in interest cover ratio, a decrease in interest cover will lead to a change in the company's credit rating by the leading rating agencies. He has been informed that the following changes are likely. Please note, interest cover of...
Sorry, sir, I don't know where you're reading from.
Can't you see my screen being shared?
Okay, I thought you said we should open our...
Is it in your study pack too?
Yeah, what page, please?
I don't have study pack here. Go to capital structure.
202.
Look
Question
at
202.
Okay, thank you.
Have you seen it, please?
Yes, please.
Okay, we can continue now. is aware that as gearing increases, required return on equity will also increase. And the company's interest cover is increased. A decrease in interest cover will lead to a change in the company's credit rating by the leading rating agencies. He has been informed that the following changes are likely. Please note, interest cover. If the interest cover is above 6.5, the rating is AA. Cost of long-term debt is 8%. If the interest cover is between 4 and 6.5, the rating is A. Cost of long-term debt is 9%. Interest cover ratio between 1.5 and 4. The rating is BB. Cost of debt 7%. Please note this information. The company is currently rated A. Please asterisk in your study pack. If the company is currently rated A, that means the company cost of debt is 9%. Are we there, please? Next.
Yeah, we are.
Summarized. So please, as you read question in exam, be mindful of what you are reading, because there's no luxury of time. Summarize financial data. Net operating income. Please note your net operating income. Less depreciation. You have earnings before interest and tax. The interest, your tax rates, capital spending, and what have you. Other information. Market value of equity, 458 million. Please, let's assume we are using Naira. This question was taken for ECCA. So assume we are dealing with Naira. Market value of equity, 458 million. Market value of debt, 305 million. Couples, cost of couples, equity beta, 1.4. The beta of debt may be assumed to be 0. Risk-free rate is 5.5. Market return for 14%. The company's growth rate of cash flow may be assumed to be constant. Please note that growth rate is constant, and to be unaffected capital structure. Change in capital structure will not affect growth rates. Requirements. A. Determine the likely effects on the company's cost of capital and corporate value. If the company's capital structure was, Roman figure 1, 80% equity, 20% debt by market value. Roman figure 2, 40% equity, 60% debt by market value. Recommend which capital structure should be selected. Now, next note. Any change in capital structure will be achieved by borrowing to repurchase existing equity. or by issuing additional equity to redeem existing debts as appropriate. Okay. The current total value, market value of equity plus market value of debt, is consistent with the growth model. Look at the growth model. Cash flow in year 1 divided by K minus growth rate. What is this model? This is Gordon model. Cash flow in year 1 all over K minus the growth rate. Is consistent with the growth model CF1 divided by K minus G. Apply on a corporate basis. CF1 is next year free cash flow. K is the weighted average cost of capital. And G is the expected growth rate. Company free cash flow may be estimated using earnings before interest and tax, bracket 1 minus tax, plus depreciation, minus capital spending. States clearly any other assumption that you have made. 20 marks. Now the question is, what is the effect of change in capital structure on the company's cost of capital and on the company's corporate value? To address this question, because at every point in time I'm lecturing, I always pray that God will give us a better understanding of what the examiner is asking us. Try to reason out what the examiner is trying to ask. I want to determine effect of change in capital structure on the company's cost of capital and on the company's corporate value. That means I must know the company current capital structure. I must know the company current cost of capital. I must know the company current value. I will now look at it. If gearing changes to 80% equity, 20% debt, what is the new cost of capital? What is the new corporate value? If gearing changes to 40% equity, 60% debt, what is the new cost of capital? What is the new corporate value? This is what the examiner is asking you. Before you start now, you must guess what is the company's current capital structure? What is the company's current cost of capital? What is the company's current corporate value? Now we now move to solution platform. I should be able to share the two screens. Okay. Now I have solution will be taken in the classroom. We have the whiteboard shared. If you have your material, no problem. If you don't have the material for the online students, we are going to navigate between the my two screen, the question screen and the whiteboard for solution. If you want to write, no problem. At the end of the class, the solution will be shared with everybody. So if you are not writing, no problem. Please get your calculator ready. Solution will be provided in the classroom. So let's go to the business. The first working. We want to determine the current capital structure. Working 1. Current capital structure. Value of equity. Value of debt. All right, let's navigate. Oh, I'm looking for this thing. Now look at wasting my time here. Look at the market value of equity. How much, please? Look at the market value of debt. How much, please? We can unmute and speak.
Market value of equity is 458 million.
Good. Let's navigate, move on. Market value of equity, 458. Market value of debt, 305. Total value of company. Value of company, please add.
763.
763. You cannot get percentage out. If I want to get the percentage out, if I want to bring in percentage, equity percentage, this is equal to 458 over total value of company. Please work this out. Multiply by 100. Please
60%.
work it out.
60%.
60%. Debt equity, so debt value, debt percentage. You can also work that out. 305 over total value of company. Multiply by 100.
40%.
What do you have? That 40%.
Approximately.
Yes. That means the current capital structure in percentage, 60% equity, 40% debt. Is that clear, please? Is that clear, please? We have taken working 1.
Yes, sir.
We save and move to working 2. We save and move to working 2. Working 2. Working 2. I need to get current cost of equity. Current, because I want to calculate my current cost of capital. Your current cost of capital is your current work. I require current cost of equity. Cost of equity. Current cost of equity using CAPM. Using CAPM. What is the formula for CAPM, please? RUF plus beta bracket RUM minus RUF. Look at the question, please. What is risk-free rate? 5.5. Look at the additional notes there. Can we see it, please? Can we see it, please?
Yes, we can.
Yes, please.
Please, if you cannot see, please speak out. Then plot, what is the beta of the company? Equity beta.
1.4.
1.4. What is market return, please? Sorry, return on market.
14%.
14. What is risk-free? 5.5. So please compute the company's existing cost of equity. Please work this out. What do you have?
17.4%.
Thank you, 17.4. Thank you. What is the company cost of debt? Anybody? Cost of debt. Currently, 9%. The company is currently rated A. Go and check it. If the company is rated A, its cost of debt is 9%. Please, what is the formula for WACC? Please, what is the formula for WACC?
WACC is E all over E plus D times K over A. That's equity. Equity
Okay.
all over equity plus debt into multiplied by cost of equity.
All right.
Plus.
I understand what you are saying. Cost of WACC is cost of equity multiplied by percentage of equity bracket plus open another bracket cost of debt after tax multiplied by percentage of debt. Your work is equal to our cost of equity, 17.4. Percentage of equity, 60%, 0.6. Plus cost of debt after tax. Cost of debt 9 multiplied by 1 minus the tax rate. What is the tax rate in this question?
30%.
0.3. Then when you get this, multiply by percentage of debt. 40% our debt. This, you can also use the one Joanne has taught you, but this will fly easily with us. You can also test run the one Joanne has taught you. Calculate your work. So what is the current work, please?
So this cost of equity, I'm not getting 17.4. I'm getting 15.4.
It's not possible, please. What you have on this board, you must get 17.4. 5.5 plus 1.4 bracket 14 minus 5.5.
Okay.
You must get 17.4. Please look at it.
$14.49.
You should have 12.96, your work.
Yes, I got 12.96.
Yes, sir. 12.96.
You should have 12 point, nothing like 14 point. You must have 12 points. You must have 12 point. Where's my this in line, please? How is it going up now?
Sorry, Mr. Asuaju.
Yes.
Sorry, the formula for work. What if we use the other formula? Are we going to
You get
arrive?
the same thing.
Okay, thank you.
But that one is taking time. Me, I can't be doing that one if I do it. So our work is, you can try it. Our work is 12.96. So somebody said it's not getting cost of equity. Are you fine now, please? Are you fine now, please, so that we can move on? Are you okay with the cost of equity now? Okay. We have tried to ask questions. Now we save this. Now working to we have gotten the current capital structure in percentage. We have gotten the corporate value total 763 million. No, 763. The current work. So please note it. We move to the next slide. In summary, if you are doing summary, summary of what we have computed, the summary of our first computation, current capital structure we have 60% equity, 40% debt, current WACC is equal to 12.96%. Current value of the company, current value of company is equal to 763 million. Now, examiner says new capital structure. Look at it here. New capital structure. He gave us two, Abby. What are the percentage, please? Roman figure 1. What do you have there? 80%. Look at the question, please. 80% equity, Abby. Hello?
Yes, 80% equity.
Yeah,
20% debt, Abby. Roman figure 2. 40% equity, 60% debt. Now, please note, once there's change in capital structure, you must recompute your work. You must recompute company's value. Once there's change in capital structure, the capital structure has changed. That means work will change. Cost of capital will change. Corporate value will change. So I will say this. We now move to the next slide. Working. So I will start with new capital structure 1. We are going to deal with new capital structure 1. We are going to later we'll now deal with new capital structure 2. So please notice. We move to the new working notes. Working 4 now. Working 4. Capital structure, or we can also call it gearing. Gearing is now 80% equity and 20% debt. Please note, once gearing changes, the first thing you are going to do is to ungear your equity beta. The financial risk has changed. That means that equity of 1 is no longer valid. The financial gearing has changed. the first thing you are going to do is to ungeared your equity beta. If you say ungeared your equity beta, it simply means convert the equity beta to asset beta. Let me repeat that point. As soon as a company capital structure changes, that means the risk has changed. The existing WACC, sorry, the existing equity beta is no longer valid. Alternatively, you can use M&M here also. Alternatively, you can use M&M here. The first thing you are going to do, ungear your cost of equity. Let us use M&M. Please, what is the formula for cost of equity? Where there's corporate taxation. Let me go back to it for the purpose of, where's my mouse? I want to go back to what we have explained. I want to use M&M here. I want to demonstrate M&M with this question. You can see why you need to know this M&M. Why are we using taxation? There is taxation in this question. The tax rate is 30%. So with corporate taxation, look at the formula for M&M. Cost of capital. Sorry, cost of equity. Please look at it. The cost of equity of a geared company is equal to cost of equity of an ungeared plus bracket 1 minus tax, close your bracket, open another bracket. So I will take this formula to the working sheet now. I want to use this formula to treat this question now. Look at it. It's also ungeared. I will come here using M and M. Cost of equity of a geared is equal to cost of equity of an ungeared. Ungeared means, when you say ungeared, you are ungearing the cost of equity now. Plus where is the mouse, please? Plus bracket 1 minus tax. Close your bracket. Open another bracket. Cost of equity of an ungeared minus cost of debt. Brackets. Open another bracket. Value of debt over value of equity. Now, if this company is geared, the cost of equity is 17.4. I want to ungear this cost. Cost of equity of an ungeared, I don't know yet. I want to calculate it. Represent it with letter X plus 1 minus tax. What the tax rate is 0.3. Open another bracket. Close this. Cost of equity of an ungeared, I don't know yet. X. What is the cost of debt? We are told that assume that this company debt is risk-free. Let's go to the question. We are told in this question to assume that the debt is risk-free. Look at it, please. Look at it. The beta of the debt may be assumed to be 0. If the beta of the debt is 0, it means the debt is risk-free. In that case, the cost of debt becomes 5.5. The risk-free rate is 5.5. I can go back here now. We are told to assume that it's risk-free. I can come back here now. This becomes 5.5. Value of debt currently. The debt is 40%. You can use 40. Oh, sorry. Value of debt or value of equity. Value of equity is 60. Work this out. We are trying to calculate what is X. I need to change this. This becomes if you come here, this is, yes, please, what's your question?
Why did you use the 5.5 as the cost?
The examiner says, assume that the beta of the debt is 0. When you say beta is 0, the risk of the debt is 0. Look at it, please. The beta of the debt may be assumed to be 0. It means that this company debt is risk-free. You now come to risk-free rate. The risk-free rate is 5.5. We are now using M&M proposition. That we are told to assume that debt is 0. If the beta is 0, it means that debt is risk-free. What is the risk-free rate of return? Is that clear, please?
Yes, sir. Thank you.
You can now come here now. You have your 17.5.4. X I'm trying to calculate plus this will give me 0.7. If I open this bracket, 0.7 multiplied by X, I will have 0.7X. 0.7 multiplied by 5.5. What do you have, please? Minus. What do you have, please?
3.85.
3.85. Then I still have a bracket here to deal with. That bracket will still affect everything here. 40 divided by 60, what do you have?
0.67.
0.667, something like this, Abby?
Yes, please.
No problem. I have 17.4 is equal to X plus, open this bracket again. 0.7X multiplied by 0.667, what do you have?
.4669.
Okay, let me check it out. I want to see how to approximate better. I just want to check that out. 4 divided by, I don't want to approximate, 4 divided by 6 multiplied by 0.7. Okay, I have 0.466. Okay, that's fine. You still have to approximate, no problem. Oh, no sense. I'm going to have my 0.4667x minus, please multiply 0.667 multiplied by 3.85. What do you have?
2.56795.
2.56795.
or approximately.
No
Yeah.
problem. We can collect like terms, Avi. This become 17.4 plus 2.56975 is equal to 1.4667x. Please add this. What do you have? 17.4 plus 2.569. Please add. What do you have?
Sir, it's 795, not 975.
Oh, 7. Okay. I have to adjust that to.
Yes, sir.
We can actually approximate self. The time is, we are good with the time. Oh. Okay, let me just try and round up this. 2.56795. Please add. What do you have? What do you have here?
19.96795.
So divided by
1.4.
Just give me the final value of x.
13.6.
13.61.
13.61. This is the cost of equity of an ungeared company. That means you have ungeared the cost of equity. This is the cost of equity of an ungeared company. What it means that you have ungeared the cost of equity. That you have removed the existing capital structure. The existing capital structure is 40% debt, 60% equity. You have removed the existing capital structure of 60% equity, 40% debt. You have ungeared. When we say ungeared, it simply means remove the existing capital structure. Because the capital structure has changed. When we say ungeared, what you have done here is to remove the existing capital structure of equity 60, debt 40. Then you now go to working 5. You now regeared. You are going to regeared with the new capital structure. The new capital structure is equity 80, debt 40. So what you have done here, let me put it as a note. Also, please notice what you have done in working 4. What you have done here, okay, I want to change this in. What you have done here is on GH. On GH. On GH. Meaning removing existing capital structure. Please allow me just like 10 minutes. I'm aware because I equally have class tomorrow morning. So we save this. We are moving to the next working. We now read GH. Working 4. Thank you for answering the question. Somebody has answered that question. How we got 3 points. Thank you for answering that question. Working 5 now. Read GH using new capital structure. Remember, new capital structure, 80% equity, 20% debt. Look at how to reject. Your cost of equity of a GH is equal to cost of equity of a non-GH plus 1 minus tax, brackets, open under brackets, cost of equity of a non-GH minus cost of debt, bracket, value of debt of equity. Cost of equity of a GH is GH. What we calculated, 13.61 plus 1 minus the tax rate 0.3. Close these brackets. Open another bracket. Cost of equity of a non-GH 13.61 minus cost of debt, if the debt is risk-free, 5.5. Close these brackets. Value of debt now. Value of debt now is 20. Value of equity now is 8. Please, what is your cost of equity now? Please work this out. It will give you 15 point something, 0 something, I think 0.4. Please work this out. Please confirm and work this out. But you should have 15.04. Or let me know the answer you have. We are going to stop here because the agreement is to stop by 11. For the online class today, we are going to round up this question on next week. So we are going to stop here. So please confirm this.
15.02.
Oh, 02, fine. I know it's in this range. So this is how to ungeared and regeared using M&M. You can also adopt another approach, but it's also M&M. You know, you have asset beta formula. You have equity beta formula. You can also do that. You are still going to get the same thing. So any question, we are going to stop here. For the online students, please note where we stopped. By God's grace, next week, we are going to round up. We can, yes, your question.
So while we're trying to ungear the equity beta, right? Or the cost of equity.
I can't hear your question though.
So while we're trying to ungear, I noticed we used all the information in the previous solving. That is the capping formula, right? So, but then it's only the cost of debt that was changed. So I want to know why we didn't use the 9% that was
okay,
used.
I think I explained that. Somebody has that same question. Now, let's go back to that question. Look at additional information. Market value of equity is what? 54. Market value of equity, examiner says 458 million. Market value of debt, 305. Next, Coupler equity beta, 1.4. The beta of debt, that debt, the examiner said the beta may be assumed to be 0. Beta is the index that measures risk. Examiner says the beta, the risk is 0. Now, if the risk is 0, it means that that debt is risk-free. If that debt is risk-free, it means that we are going to use for M&M purpose, we are going to use the risk-free rate. The risk is an assumption made under M&M. In reality, that debt is not risk-free because the cost of debt is 9%. The examiner says, assume that that debt is risk-free. If that assumption holds, that means the risk-free rate, the cost of debt is going to be the risk-free rate for the purpose of M&M computation. Why we didn't use that 9% was because of the assumption the examiner has given us. The examiner says the beta of the debt may be assumed to be risk-free. Is that clear, please? All right. I was waiting for the rest. I was asking a question from the is that clear, please?
Yes, sir, it is.
Okay.
So I got
like
15.01.
You got what?
15.01%.
36, K.
15.01.
15.01. Somebody got 15 points. Oh, points. Okay, that's fine. It's okay. It's rounding off effect because I've solved this before. Because it's you are fine. You have gotten 15.01. Somebody got 15.02. Somebody got 15.03. Is the effect of rounding off. Is that clear, please? That is not material to, it's not material to that. You have gotten 15.01. Next person got 15.02. Is the effect of rounding off. All right. Let's have a blessed evening. We stop here. Of course, to meet again by God's grace for the physical class students. All right, good night.
Thank you, sir. Good night, sir.